Good evening, guys and girls. I'm looking at a 30-minute chart going back for 1 week. I'm at the high here, retest failure. I have this drawn a declining wedge. Here's support, here's resistance. And today we're going to talk about a special trade that has worked for 16 years. We're now going into our 17th year. It's been in my book about 4 years, and it'll be 4 years this year. And normally the average return, it's 100%, 17. We're shooting for 17 years in a row. We're looking to make an average of 3 times our money return. So here we are setting up the day before. We're looking, I write on the chart, I've got the arrows, the declining wedge. I'm looking for an IRA tax trade. Now, how this works is the money leaves the market for 3 or 4 days before the 15th. You have to have your money out of the market. 80-90% of the people pay out of the market. And then you invest the funds and the market goes higher starting at 14, 15, 16, 17, 18. And this year it might be a little different because they don't have to have the money in until the 18th Monday. There's some holiday or something like that. So anyway, here we're looking to set up a tax trade. And what happens normally is we're in expiration week. That is the third Friday of every month. And I wrote an email on Sunday telling you they will take the market down, but they will hold a 1300 level, give or take, because there is a gigantic put position because the market had been down sharply in March, and there's gigantic put position that they want to expire worthless, but there are a hell of a lot of calls over 1300 from the bullish contingent. So what they normally would do, my experience is doing this 28 years, is they will take out the calls, take the market down, jam it hard down, below the 1300 level, get everyone long out, get everyone short in, and then reverse the market. And that's what happens. And then we're looking to buy calls on that situation, and we're looking to make money. So here we are, basically Wednesday night, and we're looking at the market. I'm going to move it forward a little bit, and look what happens. We gap down. See, we take out support. Every long is now stopped out officially. Every short is jumping in because we just broke support. But you'll notice on the 5-minute chart I talk about 1297, 1300 being support, being the 40, going back to here, and I'll move it ahead one. Support, a 40% retracement, which is really 38, the 316, and we're now going to rally. So I sent out an alert first thing in the morning. We're looking to buy the 40s, 40-cent options, which will be the 590s, throwaway trade. Again, they're about 10 S&P points out of the money, but the real trade comes in under $2 on the 585s. We want to buy those. Now, what I'm going to do, I'm giving you the setup. We take out support, get everybody who's long out, get everybody who's short in, and then we reverse it and we jam it very hard. I've done videos on this before. It's in my book. It's fairly straightforward, but this is current. So here's something written 4 years ago. Same stuff is going to happen. Now I'm going to go to the 5-minute chart and what you're going to see, and I will just go through the day. Here we are. We open up. We fail. We come down to the 40 of 316. We're jammed. We get a crossover. Middle's higher support. Look at this. Support 1297, 1301. This is the support I sent out in the alert email. We want to be buying calls. Resistance early, 1213, 15. The advanced decline line never went positive. We started out almost 3-to-1 negative right from the bat. This is what you want to see. You want to see a horribly negative market, okay? And I write, we're buying the 175 scale in, or the throwaway trade is the 590 weeklies. These are the weekly options at 40 cents. Throwaway trade, go IRA tax trade, okay? Remember, 17 years we're looking for a triple. Market goes up, we start to hedge, okay? Because we can't sell the options. I mean, God, we don't make any money. We blow out the options here. We're looking for a bigger gain. Start hedging, goes up a little higher. Okay, this is the breakdown level. Okay, right from the night before. Here's your closing low. We go down to a very big buy level, jammed, crossover. Sign of weakness, 62.71 from a jam. Automatic sell. We start to hedge small here. Calls hit 310, 85 cents. Not bad trades from $1.75, 85. Big hedge. Big time here, right here. See, we're failing under the breakdown point. See, this becomes resistance. Support becomes resistance, resistance, right here. All right? Now we're hedged because we're in the options deep in the money. We're in the money now. We're approaching in the money options. So we're going to hedge big time. The market's had a nice rally. The options have gone from $1.75 to 3, from 40 cents to 85. Not too shabby. Okay, resistance, remember. ADs never went positive here. We're starting to draw an ABC swing. A, B. The market moves down sideways, 40. It goes a little lower. The hedge is now making us $125 to $175 per option. That's incredible because anyone paying 40 cents for an option has already made his money, made 3 times his money on the hedge by selling in here. Okay? If you paid $1.75, $2, obviously you're not making a lot of money. It's going to take a while to make the money back because that's the mystical force I talk about in the New Trading Era Bible. They are the mysterious force that broke support, stopped all the longs out, let the shorts in, and then jammed them. Whoops, pardon my language, a new asshole. So the market goes down. You can see we don't even come down to oversold or jammed. We have a retest failure. We're at a 50%. So I can do an ABC swing target. In fact, I'll show you how we do it. Take the trade station tool. We take here. We go to here. We go back down to here. And look at that. Isn't that nice? It gives us 100% retracement. This is the target 2. This is what we're expecting. Okay, the market comes down. We cover our shorts. We now let the calls run. Start retest failure. Resistance. Start selling in here. Goes marginally higher. We hedge. Let's say you're long 50 options. You probably sell 15 up here. You sell 25 up here. Because we're in the money. We're going to be 80-90% hedged. Market's not going to blow us out. Okay, the ADs, remember this whole time the ADs never go positive. I mean, we're still in a weak market. Okay, we're at 60% from the high of the previous day to the low. 60%, retest failure time of day. 1 o'clock is time of day. We're in a trading range. We're looking for the market to go down. The market goes down. We earn $100 on some of these shorts. Market rallies back. Support becomes resistance. Resistance becomes support. Well, we're still at resistance. Hedge again. I'll pick up another $100. Guys, we're kind of making money. 125, 170. So let's split the difference. Say we made 150. If we paid 40 cents for the option, we've already paid for it 3 times. If we paid $1.75, we've paid half of it. Now we paid for the long options. We paid for the deep in the monies. Okay, we earned it $100 again. Little hedge again. Still failing. Little nice reversal bar. That's what all these rectangles are, little reversal bars where we can get long. See, get long. See, these are not as good. Look at this nice reversal bar. Fails, comes right back in, hit it again, goes a little higher, short some, pick up another $100, being 100, 175. Guys, you're up $375. Now you paid for your $1.75 option, but you just made about 4 or 5 times your money on the other one. You're doing now, and maybe not as much, because in the money we go up into 100% hedges. Out of the money, maybe 40, 50%. So maybe you don't make as much money. You don't make 4 or 5 times your money with the hedges. Meanwhile, guess what? This now becomes support. We start taking out some levels. We start holding. Here's the big 40. From the low of the day to the high of the day, this is a 40% retracement. Oversold. Look at this. Overbought. Oversold. Overbought. Then guess what? We start hedging again. Pick up another $100. And guess what? This is a time to go down. I'm sorry. We're going up. 2 o'clock is the time to go up. We go up. Look at this. We can't even come down. We can't even break the 20 exponential moving average. We are now going higher. See? Overbought. Sell it. Hedge. We can't come down. Now the market starts breaking out above here. And guess what? We go right to the target. Right to the target. Now look at this. Average IRA tax trade is 3 times over the last 16 years. We're close here. See, we're close here. The option is trading $3.90, $1.05. We paid 40 cents for the opening on the opening. Okay, I should say on the first not the opening. We saw it go down. We could have been 60 here, down to 40 cents here. We're now $1.05. See, we're close. Again, the 590s were more than paid for, okay? But we need another hedge to pay for the 585s. Okay, the market comes down, hedge, hedge, hedge again. This now becomes support. We take out this entire shelf. We take out this entire shelf. This will become support, okay? Now we go up, look at what's sitting up here. This is a retest failure, 40% of 4.8. So from some high, which on a 30-minute chart, okay, we're at a 40%, and we're at the T2. Look at this. We're right at the T2, 13 or 12.50. We're at 13 and a quarter. The high at that time is 13 and a quarter. So what do? We sell, we sell, we sell, cover a little bit in here. Here's another $200 trade. Now I also wrote, calls hit 460 and $1.40, hit the T2 target, take some profit. So sell half, sell 3/4. You know, we made our triple. Now I think the market will go higher. Okay, but look at this. Here's another free trade, 200, 100, 100, 175. Let's make it easy. 275, 100, 375, 575 for every option, every put you're making profit. I'm sorry, every call. You're making $500 in profit on a $200 option, and the option hit 460. Not only did you pay for them, you made a phenomenal money. You sold some up here. Definitely. You definitely sold some up here because we hit the target. And look at the ADs. The market barely goes profitable. And don't forget, Google's going to report after the close. And I don't think the world's looking for some relief. I don't think it's going to happen, but it doesn't matter. So you hedge some, you close it out. Now if the market rallies in the overnight session, great. You'll sell something to lock in the profits. If the market comes down, you may buy some because remember, the biggest position in this situation here is they, the mysterious force that rigs the market, want the market to close by 9:40. They want the market to be over 1,300, so all those puts expire worthless. And then the market's free to do whatever it wants with the OEX because the S&P 500 puts expire Friday morning on the opening. So anyway, they did their job. The market came down. If you take a quick look at the 30-minute chart, I'll go through it for you quickly. I hope this thing comes up. Boy, it's slow. Okay, I'll move this forward. Okay, see it? You can see it all. Same thing here. You can see what they did. Nice breakout of the downtrend line. You got to follow this up if you wanted to trade. And we're overbought. That's it, guys. We got our triple. 17 years in a row, IRA tax trade worked. You can see the market, well, a downtrend, jammed 62, jammed 62. It contained the entire downside, broke to new lows, caught everybody on the wrong side, and rallied up to the biggest 40 of the 5 days. Thank you all for listening, and hopefully we'll be back soon with another story. Thank you all.